All right. Hello again, everybody. This is Mike Rixey. I'm the lead options instructor for NetPicks, and this is our options trade of the week. We will jump over to that new trade for this week in just a moment, but we're going to circle back to our trade from last week on Lululemon just to give an update on where things stand, how we plan on managing the trade. And if you have any questions on this open position, if you do have it on, feel free to reach out. You can email me directly, mike@netpicks.com, or you can just leave a comment on the video here in YouTube, and we will go ahead and respond right away. So let's take a look at Lulu. We have seen a very noisy market. If I jump over real quick here to the daily chart of the S&P 500, you will see the last week and a half, 2 weeks, it's just been very, very noisy right inside of this cluster of moving averages. We've had this range defined by 449 on the upside and just below 440 on the downside. We've tried to break through this lower level a few times, but every time we test just below that 200 EMA, we bounce right back to the upside. As a result, we've had some pretty decent intraday range, some decent intraday movement. We just haven't had a lot of follow through into day 2, 3, 4, 5. As a result, we have had a lot of indecisive chart patterns when we go through our watch list, a lot of choppiness kicking in. We are heading into earnings season. A lot of the big tech names will have their earnings out over the next few weeks. That's something to keep in mind. This is very typical when you're going into a stretch of uncertainty. A lot of times you can see the noise kick in. Now, the volume has been a little bit on the light side compared to what we've seen for most of this year. It's been pretty steady between 60 and 70 million shares on SPY. So I point this out. We've got the VIX above 22. There's still uncertainty being priced into this market. I point it out because it can impact how we trade. We all love to trade long calls and long puts. We all love those big directional moves when they happen because they can lead to some pretty big returns, right? We also know that the market's not always going to make it that easy on us. There's going to be times where we're going to play defense, right? We're going to take a more conservative stance until the market gives us a more favorable type environment for those aggressive strategies. You take a look at this daily chart. Is there a clear trend in place here over the past few weeks? There's not. We're just kind of building energy inside of this range. And I think the range will break at some point in the near future. I think we're going to get a very decent move out of this range. We just don't know when that break is going to come. We'll certainly adjust our approach if and when that happens over the next few days. When we circle back next week for our next video, we could very well be talking about a market that's just flying, right? Making big directional moves again. And that will be a time where we can adjust and take a look at some of the more aggressive strategies, like just buying individual calls and puts. However, given that we are in a more noisy type market, let's take a look at how that impacts us for not only the Lulu trade from last week, but also the new trade that we're taking here for this coming week. If we take a look at the 130-minute chart on Lulu, those of you that watched the video here last week, you heard me talk about selling an out-of-the-money call spread on Lulu because of the overbought condition that was in place. We are expecting the market to pull back. And if you haven't had a chance to watch that video, you can always go back and view it on our channel. If you have not subscribed to the channel, make sure you hit the subscribe button so you are notified when we do release these videos. So on Lulu, the whole premise for the trade was price action getting to this overbought condition. If I take a look at our pulse histogram down at the bottom, it was plotting yellow, green, blue, indicating that price was between a 1 and a 3 standard deviation move on the upside. It doesn't mean price can't move higher. It just means it's not statistically probable. When you see that type of an extreme, in many cases, it will lead to some noisy conditions or even a reversal to the downside, right? So we were expecting to move lower. What has happened since then? Well, we got another leg to the upside, right? Even though it wasn't statistically probable, it was still possible, right? And we found that it ended up playing out again to the upside. So now we're left in a defensive position. What do we do with the trade that we put on? Let's jump over to the trade page and let's take a look at it because our outlook hasn't changed. Price is still past a 1 standard deviation move. If I take a look at these yellow bars in the pulse, what that's telling me is that only 13.6% of all occurrences are going to fall outside of this range on the upside. Again, can it happen? Sure. It's just the numbers don't back that type of a move up. So my outlook is still looking for either a pause or a reversal to the downside. And if we take a look over at our Lulu trade, when we put it on last week, we utilized the April 29 options. We are using the weekly options so we can guarantee that we're out before earnings. I don't want to hold this position through earnings. I want to make sure that I'm out ahead of time. Now, when we put it on, we sold the 385, 390 calls here, meaning I was selling the 385 call, buying the 390 call. The ideal scenario here is for price to stay below 385. When we put it on initially, it was a neutral to bearish position. Unfortunately, price has moved higher and now we're at 387.5. And it's actually trading higher than that here pre-market. So now what do? I need price below 385. I need another push to the downside. This has certainly gone from a neutral to bearish position to, at this point, it's a bearish position. I definitely want a move to the downside. So now what do? I sold the spread to open up the position last week for $150. It tied up $350 of my capital. That was my maximum loss. It's now trading for $257. I'm down about $100 per spread. There are 10 days left to expiration. What do? We talked about it in an earlier video on Tesla. We've got a couple of options. I could close it out and take the partial loss now. That's option number one. Option number two is to roll the position farther out in time. And what that would mean is I would close out of the existing position and open up a new position out farther in time. That would give me more time for that move to the downside to develop. Problem with that is going into earnings, I don't really want to roll the position here. I'd rather just get it done with, close it out, and not have to worry about the stress levels being elevated going into earnings season. So the other option would be to hold. We still have 10 days left to expiration. I need to move below 385. Well, how likely is that to happen? If I take a look at those April 29 options on the far right-hand side, there currently is between a 50 and a 51% implied volatility that's being used to price the options. What that means is between now and expiration next Friday, there is a $26 move being priced into the options. A $26 move higher or lower, right? So now it's not going to tell you whether the stock is going to move higher or lower. It's just telling you the range that is being used to price the options. Market makers are expecting a pretty active stretch. We only need a small move to the downside. It's still very possible that between now and expiration next week, this thing can still battle back for us. The benefit is the time decay continues to add up in our favor. Every day that passes, that helps those options lose value. That's to our benefit. And then the gamma also increases the closer you get to expiration. The gamma tells you how quickly those options are going to react to changes in stock price. These options are going to be very sensitive to anything higher or lower in the stock price over the next 10 days. If we do get a move lower, this thing can battle back, get back into a partial profit very quickly. So all that to say, I'm going to continue to hold this current trade as is into the next couple days, potentially into early next week. I'm not going to adjust it. I'm not going to close it. I'm going to hold the trade as is and see if we can get one more push to the downside, see if this thing will battle back into profit for us. As I mentioned a few moments ago, if you have any questions on this one over the next few days, if you're not certain on how to handle it, feel free to reach out. We're more than willing to give you some feedback and keep you posted on what we end up doing on our side. And then when we circle back for our next video, we'll certainly take a closer look at this. That way we're keeping an eye on it for you from start to finish. All right. So now let's go on over to our new trade for this week. And we're going to go to one of the bond ETFs, one of the leveraged ETFs tracking the bond market. A lot of the weakness in equities, a lot of the noise that we've seen in equities lately has been because of this move in bonds, right? We've had bonds just relentless. You take a look at TLT. It's had a pretty big move to the downside. TBT, the one that we're going to be looking at, is going to move inverse of TLT. So now we've got these price extremes. How do we quantify that? Well, if I take a look at that 130-minute chart of TBT, I've got yellow bars. I've got 6 in a row on the pulse indicator, indicating that price is between a 1 and a 2 standard deviation move on the upside. It doesn't mean price can't continue to move higher here on TBT. It just means that's not statistically probable. In the near term, we're overdone. Only 13.6% of all occurrences fall outside of this range on the upside. So now my expectation is for price to either consolidate here or even reverse to the downside. Now, I'm not saying a major turning point is coming for bonds. I think the bond market is probably in for some additional hurt in the months to come. But I'm talking about in the near term, over the next 2 to 10 days, are we potentially in for a near-term reversal? That's the expectation, and that's how we're going to structure the trade. We're going to structure the trade with a neutral to bearish outlook on TBT. So if I jump over to the trade page, let's go ahead and change this to TBT. And what we're going to do is we're going to look at the May 20 monthly options. These right here with 31 days left to expiration. I'm going to go ahead and open those up. We're going to take a look at selling an out of the money call spread, which is a neutral to bearish position. The benefit with selling a call spread, we're going to tie up less capital when compared to just buying an outright call or put. And it's going to give us a trade that's going to leave us with 5 ways of making money on the trade. Instead of only having one way of making money, if we buy an option, we're going to give ourselves multiple ways of making money. And that's going to leave us with a more forgiving type trade. In this market, like I talked about, with so many noisy moves, so many false moves in both directions, I'm going to lean towards these more conservative trades, these more forgiving type trades. So what we did with our ETF Option Superstars members, we did this one yesterday afternoon. We came in and we were looking at the 25.5 call out in May. I was going to right click on the 25.5 call, go to sell and go to vertical. It's going to pop up an order down at the bottom where I am indeed selling the 25.5 call, but I'm going to stretch that long call from 26 out to 27. And that leaves that spread trading for 40 cents or $40 per spread. If I click on confirm and send, you'll see the profile of the trade. I'd be risking $110 to make 40, only tying up $110 per spread. So very reasonable cost for any account size. And if you do have the big year account, you can trade this with 10, 20, 30 spreads, still keep your costs relatively low. I mean, you take this with 10 spreads and you're talking about just over $1,100 per contract. So very reasonable to scale if you do have the bigger account. Now, collecting 40 cents on this trade, that's our max profit. If this one does move to the downside, the most I can make is $40 per spread. You're looking at that saying, Mike, that's really not a lot of profit potential there. Well, remember, I'm only tying up $110 to begin with, and I give myself 5 ways of making money on the trade. I make money if TBT moves up, down, or sideways, as long as it stays below 25.5. I also make money from time decay adding up, which it will. Every day that passes, that will help me. And I make money from volatility decreasing if it does. That gives me 5 different routes to follow. Ideally, I want the stock to move lower. If it does, that's going to allow me to make money the fastest. If it doesn't, if it just chops sideways or even maybe just to the upside a little bit further, I can still work with that. I'm just gonna have to hold the trade longer in those cases to get more time decay working in our favor. Now, my target zone, anytime that I sell a credit spread, I'm looking to keep between 50 and 75% of the max profit. My max profit is 40 cents. I'm gonna look to close this thing out for between 10 and 20 cents. Anywhere inside of that range would allow me to book the partial profit, not have to hold the expiration and stress out about how active the options get close to expiration. I'm going to look to book the partial profit, free up the capital, and move on to the next trade. So with 31 days left, if we get a sell-off over the next 3 to 7 days, that's going to allow us to get pretty darn close to that profit range. If we don't get the sell-off, we'll probably have to hold closer to 15, 20 days just to let more time decay work out in our favor. All right. Now, that was the Thinkorswim platform. Let me go ahead and pull up the Tastyworks platform, and I'll show you how to place the trade over there as well. So just give me a quick second, and I'll pull up Tastyworks. All right, so inside of Tastyworks, I went to the trade page. I changed the symbol to TBT, pulling up the leveraged bond ETF. We're going to go to the May 20 options. I'm going to open those up, the ones with 31 days left to expiration. If I'm putting this trade on for the first time, I'm going to come down to the 25.5 calls. I'm going to left click on the bid price of the 25.5 calls. That's going to box that option in red, indicating a sell order. Then I'm going to buy the 27 call at the same time. To do that, I'm going to left click on the ask price of the 27 call. It's going to box it in green, indicating a buy order. The sole purpose of that 27 call is to leave me in a risk-defined trade. I'm trying to hedge my risk. If all I did is sell the 25.5 call, it's going to tie up more capital. It's going to leave me with a larger loss potential. So while it does give me a bigger profit potential, it also drastically raises my risk. I don't want that. I want the lower risk. I want to know what my worst case scenario is on this trade. And we're able to do that by also buying the 27 call. You can see it down at the bottom, trading for 41 cents. I'm recording this video just in the pre-market. So unfortunately, I can't place this trade, but I did get it placed yesterday just for this video, just for this example, so I can show you how to create the closing order as well. So if I click on review and send, even though I can't send the trade here pre-market, you can see the details of the trade, right? So I'm collecting 41 cents on the trade. That's the ideal fill point there. Between 40 and 41 cents is where we were getting filled yesterday afternoon. That's my max profit on the trade, and my maximum risk with commissions factored in there is $111. All right, so now let's go ahead and assume that we were able to get filled on the trade. So that's going to pop up the order over in my positions tab. You'll see it from yesterday afternoon right here. If I click on TBT, you're going to see the two options that are part of the spread. I am short the 25.5 call. I'm long the 27 call. If I go ahead and click on both of those, it's going to highlight those in gray. Once they are both highlighted, I can right click on either one of them and select close position. Once I click on close position, it's going to take me back over to the trade page where now I can change the price. I can specify what price I want as my working closing order. So I'm going to change this to 10 cents. That would give me 75% of the max profit. So I'm going to change it to 10 cents. I'm going to change this from a day order to a GTC, or a good till cancel. That way the order remains in place for the next few days and out to the next few weeks. It's going to remain in place until I get filled at 10 cents or until I manually go in and edit it or close cancel the order. Okay, so I'm going to go ahead and click on review and send the order. Now it pops up over on my activity tab. You'll see that my working order is in place at 10 cents. Now I'm going to check in on it periodically. If my outlook changes, if I want to end up closing it out closer to 20 cents, which would be 50% of the max profit, I can certainly do so. So it's not a set it and forget it approach, but I'd like to have those closing orders working just in case. We do get these quick moves. We've had a lot of them right at the open or right before the close. A lot of times, you get those closing orders working and you get lucky and you get filled when the market is pretty active. I've had a customer here communicate with me this week where he's had a couple of cases where markets get wide at the open, the bid-ask spreads get wide, and he's gotten some pretty good fills because of those wide markets, because of the active markets right at the open. So I like to get those closing orders working. Doesn't mean I'm locked in at that price. Right? I can certainly adjust it going forward as markets change, as my outlook changes. I can certainly change that ongoing. But for the time being, I'm going to keep it at 10 cents and then we'll revisit it. Next week in our next video, we'll take a look at both the Lulu trade and the TBT trade from today and see if we can manage those and see if we can close them both out for a winner. So again, if you have any questions on the trade for this week on TBT, feel free to email me, mike@netpicks.com. You can also post a comment or a question here in YouTube, and we'll certainly reach out there as well. If you have not subscribed to the channel, make sure you do so. We'd love to have you on board tracking our videos going forward. I'm going to wrap this one up here. Enjoy the rest of your week, everybody, and I'll be back with you shortly with our next options video.